Hey everyone, and welcome. So let's just dive right in. We hear the word asset thrown around all the time, but what does it actually mean? It seems pretty simple on the surface, but really getting this concept is the absolute foundation for everything in finance. Today, we're going to make it crystal clear.
So here's our game plan. We're going to start with a super basic definition, and then, and this is the cool part, we're going to split the entire world of assets in two. We'll look at real assets, which is all about owning something, and then monetary assets, which is about owning a promise. And finally, we'll connect the dots and see why this difference isn't just academic, it's absolutely crucial.
All right, first things first. Before we get into all the really fascinating stuff, we got to build a solid foundation. So let's start at square one. What exactly is an asset? Okay, so here's the official textbook definition. And yeah, it sounds a little formal, doesn't it? But look closer. The key phrases are right there. A contractual right or an ownership claim. All that really means is an asset's value comes from one of two places. Either you own a thing directly or you have a legal claim on it. Let's just boil all that jargon down. At its absolute core, an asset is simply anything you own that has value. That's it. It could be the cash in your pocket, the house you live in, a share in a company. If it's got value and it belongs to you, hey, it's an asset. Simple as that. Okay, now this is where things get really interesting. See, the most important thing to get is that not all assets are created equal. In fact, we can neatly divide the entire universe of assets into two totally different worlds. And once you understand this divide, it's like having a secret decoder ring for all of finance. I want you to think about this for a second. They're both assets, right? We've established that. But do they feel the same? Does having $100 in a savings account represent the same kind of ownership as having $100 of stock in a company? The answer is a hard no, and the reason why is everything. And boom, here it is. This is the great divide. On one side, you have real assets. That's where you own a piece of something real, a business, a building, a commodity. On the other side, you have monetary assets, where what you really own is just a promise from someone else to pay you money in the future. It's ownership versus a promise. Let's dig into that. All right, let's tackle that first category. Real assets. The keyword here is real. This is all about direct, tangible ownership. I just love this way of thinking about it. When you buy a stock, you're not just buying some ticker symbol that zips across a screen. You are buying a tiny piece of an actual, real-world company. Its buildings, its patents, its future profits. You literally become a part owner. And this idea goes way beyond just stocks. The house you live in or an office building, that's a real asset. Physical gold bars or barrels of oil? Yup, also real assets. Even a famous painting. In every single one of these cases, you own the actual thing. And here's the key takeaway. The value of a real asset is directly tied to the value of the underlying business or object. So if the company you own a piece of does really well, or if the demand for oil skyrockets, the value of your piece goes up too. You are directly participating in its real-world success. Okay, so now let's cross that divide and explore that other world, monetary assets. With these, the whole concept shifts away from ownership and towards something a little more abstract, but just as important, a promise.
This right here is the fundamental difference. Think about it. When you put money in a bank, you don't own a little piece of the bank's vault or its furniture. Nope. What you own is the bank's promise to give you your dollars back when you ask for them. It's basically a contractual IOU.
And you see this everywhere. The money in your savings account is a classic example, or when you buy a government bond. In both cases, you've essentially loaned your money out, and in return, you're holding a promise, an IOU from the bank or the government that they're going to pay you back, usually with a little extra interest. It's a claim on future money, not a piece of a current thing. Okay, so we've got real assets on one side. That's ownership. And monetary assets on the other. That's a promise. But so what? Why does this even matter? Well, this is where it all clicks into place. This table just nails the difference. With real assets, it's all based on ownership, and the value reflects what the underlying thing is actually worth. Your goal is to participate in its growth. But with monetary assets, it's all based on a promise, a contract, and your goal is really just to get that fixed payment you were promised. They're two completely different games with different roles. And this really gets to the heart of why you should care. The number one job of your savings isn't to make you a millionaire overnight. The first goal is just to make sure that $1 you save today can still buy $1's worth of stuff tomorrow or next year or 10 years from now. It's all about maintaining its purchasing power. And that is why this matters to you personally. Knowing the difference, really understanding if you own a piece of the actual economy or just a promise to be paid back later, is the first, most fundamental step you can take to make smart decisions that will actually protect and grow your savings over the long haul.
So I'll leave you with this question. The next time you look at your bank account or a stock price or even just the house down the street, ask yourself, am I looking at ownership or am I looking at a promise? I think you'll find the answer might just change the way you see the entire financial world. Thanks for tuning in.